Hi, this is Joe Carapina at Blue Crow Trading. Today is Sunday, it's the 8th of June, it's just after noon, and the purpose of this video is to show you how traders are trapped that are using technical analysis tools, traditional technical analysis tools that have been around since the 1970s, and chart patterns that have been popularized by online trading education courses, trading mentors, and many chart schools that are now available online. So this is the Emini Nasdaq 100 futures contract using a 9-tick range bar chart. This is our preferred range bar charts, and this is the chart that we use to disseminate the intraday E-mini targets, the major and minor bull and bear targets that exist. So what we saw on Friday was consolidation taking place between that high of 37.91 and down to this low of 37.81.25, and as the day progressed towards the early afternoon, we saw a symmetrical triangle that was being created. A symmetrical triangle is where you see two converging trend lines that connect a higher low, so that's a low there, and that's another higher low on that side, and that's a new high that was created above all of these highs, and that's another swing up, so that's a lower high. So lower high on that side, higher low on that side. If you connect the two trend lines, it creates a symmetrical triangle, and it's the convergence of these two competing trend lines that then create that the chart pattern. The way technical analysts suggest that the symmetrical triangle should be traded is on a breakout out of these, out of the chart pattern. So a breakout to the upside would have been a long, a breakout to the downside would have been a short position. So let's go through each of the steps. Symmetrical triangle was created. The first opportunity that arose for technical analysts that are using chart patterns would have been a long position that would have been placed here just at the point of breaking out of that of the top of the symmetrical triangle, and a long position would have been initiated there for technical analysts. They would have placed their stop losses here at the bottom. So what happened here was a breakout. It failed. It came back down to collect all these stops that were sitting underneath of this swing point over there. Now, for technical analysts that believe that this was a breakdown, a breakout to the short side, they would have placed their entry orders just after the breakout over here, so entered short there and placed their stop losses just on top of that swing point there. Traders would have entered short. They would have been fine for a little while. There may have been an opportunity for a scalp profit there, but that would have been really optimistic because this price action moved pretty quickly. What happened subsequent to the break? It failed. It pulled up just to go and collect all these stops that were at the top of the swing point over there. And then what happened to subsequent price action is what the expectation was. There is what happened then after this price fluctuated and vacillated for a while. So that's an example how technical analysis tools used by many technical analysis traders out there result in trapped traders. So the first were trapped long and they were kicked out of their positions. The next group were trapped short, and then they were kicked out of those positions. Technical analysis tools have been around from the 1970s. You can bet your bottom dollar that the institutional players and big players are well aware of these chart patterns and well aware that many traders are entering positions at these breakout areas. The bottom line and the moral of the story is monitor these chart patterns, see where traders are being trapped during the course of the day, and how price action is anticipated to move to trap each of these traders and move them out of their positions. So thanks so much for listening. Take care and happy trading. Bye.